Good afternoon. First broadcast for Barrett Munson Realty Executives. Basically, today I'm going to be talking about the proper ways to actually pre-qualify for a loan if you're looking for a house. So, easiest way to do it, starting off the bat, first time home buyer, what you want to do is you want to look at your finances. Finances are the key. You want to check out basically what you're looking for in your credit score, what your debt to income ratio is. Basically, this all determines what your loan is going to be and what you can get pre-qualified for. So looking at that, let's take a comparison real quick. So the housing market, 2007, 2008, Las Vegas, piss poor. We went down, we plummeted. It was a roller coaster that we hit the bottom. Right now, we're actually increasing increments of 9, 7, 9% annually. Awesome job, Las Vegas. So basically what that means is housing markets are increasing. What they're not doing though is they're actually not lending the way they were back in 2007, which was the crisis of how we got into big trouble to begin with. So basically what we're doing is we're looking at your income, your W-2, you're looking at your debt to income ratio, and then you're actually looking at your credit score. So let's say first time home buyer, you want to go in, you want to look at your credit score. You can either look at credit scores through free credit scores online, you can do that, or you can actually go into a lender and actually ask them to look up your paperwork. So then basically what that means is the lender is going to look at your W-2, he's going to ask your debt to income ratio, which basically means if you're making X amount of dollars per month, what are you actually spending in expenditures? So for example, let's say you have $4,000, you're making $1,000 a week, okay? You have to take in consideration of your car payment, depending if it's paid off or it's actually still a loan. You have to take in consideration of daily expenditures, gas, water, electric, cable, all that stuff that you're either renting through or you're actually paying for per month. You have to look at healthcare, you have to look at insurance, you have to add all those things up so that hoping that you're in the 33 to 35 percentile for your debt to income ratio. So basically what that means is if you're making $4,000 a month, you kind of want to only be spending $1,500 to $1,800 a month in expenditures. The banks really like it when you have 33% to 35% debt to income ratio or less. So basically what that means is when you're done, you actually have an X amount of dollars to spend on the house mortgage. After that, you're going to want to take a look at your finances. So basically what that means is if you look into your finances, you're going to find your checking, your banking account, and all your credit cards, okay? Credit cards, if your score is a little bit lower, what you want to do is maybe consolidate your credit, put credit or take money from one credit card and put it onto another so that there's a large sum on one credit card so you don't have all these outstanding balances on multiple credit cards. If you can, I would pay off a couple small credit cards just to get your FICO score up. So basically, if you have 5 credit cards, I would keep 1 or 2 with the large amount on there and then pay 3 off. If you need to raise your score up, basically what I would do is then spend $100 to $150 on that credit card per month to see the transactions and pay it off in a month. That's actually going to raise your credit quickly so you can actually qualify for a loan. And last but not least, you're going to be looking at your W-2s. They're going to be looking at your income per year. Your income per year basically has to be filed every year through your tax return. So then basically the banks can say, okay, on paper, this is what you're making. So then we feel comfortable lending you this amount. So then basically it opens up a wide range of which houses can I look at, which areas can I look at, and that kind of determines what specialty of house are you looking at. Are you looking for 4-bedroom, looking for a 3-bedroom, 2-bedroom? Are you looking for a single story? Are you looking for a townhome? Are you looking for a condominium? I mean, there's multiple things you can do. You can be looking for a detached home, you can look for a mobile home. I mean, the range is huge. But what you have to do is you have to start with that process of finding a lender, talking to the lender, seeing if the lender is comparative on APR financing too. You want to do that. You want to say, okay, what are you financing at? 3%, 4%? I mean, there's multiple lenders out there that might give you a little bit of a better interest rate, which can actually lower your payments in the month. But at the same time, you do want to find that lender who's going to basically give you the largest pre-qual amount, because you're going to want to find that home that you can either grow old into, that you can start a family in, and those are the main goals of home buyers is that they can see a future in that home. So that's just one of the few things that you can do when you first start looking for a home to buy. Now I'm going to be posting some more videos throughout the weeks because I'm actually brand new to real estate. I've only been doing this for about 2 months now, but I really want to just share what my learning experience so far has done, and is to kind of share to everyone and tell everyone, you know, what you can do to try and start finding your dream home. Have any questions or concerns, please let me know. Any comments, I definitely appreciate constructive criticism. Like I said, I'm brand new to this, but if you have any ideas, please let me know. Thank you.